Ladies and gentlemen, good day and welcome to GMR Infrastructure Limited conference call to discuss Q3FY22 results. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. We have with us today Mr. Saurabh Chawla, Executive Director, Finance and Strategy. Before we begin, I would like to state that some of the statements made in today's discussion may be forward-looking in nature and may involve risk and uncertainties. Also, recording or transcribing of this call without prior permission of the management is strictly prohibited. I now hand the conference over to Mr. Saurabh Chawla for the opening remarks. Thank you, and over to you, sir.
Thank you. Good afternoon, ladies and gentlemen. Thank you for joining the third quarter fiscal 2022 earnings call. This is the first call of a demerged GMR Infra as a pure airport entity in the Indian capital markets. Hope all of you are doing safe and doing well. To begin with, I would like to make some comments as far as economic recovery is concerned. As you are aware, economic recovery broadened in Q3FY22 and the business activities picked up pace post the effect of the second COVID wave. Substantial vaccination of the population coupled with the easing of COVID-related restrictions aided the economic activity. However, as you know, the third COVID wave hit India towards the end of calendar year 21. Although cases surged in mid-January 22, the severity of the infection has been limited. However, the cases have also started now to recede rapidly from its recent peak of about 0.35 million cases in early January 22 to about 0.07 million cases as of February 8 of 22. As per experts, India is now much better prepared to cope up with the COVID waves going forward due to a significant part of our population being vaccinated, resulting in lower hospitalization and mortality numbers. As such, economic impact of the third wave is also expected to be very limited as compared to the previous two COVID waves. Before briefing you on the business performance, I would like to highlight the following key points. Firstly, following demerger scheme coming into effect from December 31st, 2021, GMR Infrastructure Limited, or GIL, becomes India's first and the only listed airport company. We are now well poised for the next leg of our growth, having built our expertise in the entire airport value chain. GMR Airports vertical has uniquely diversified beyond the airport development and operations. It's developed towards high growth potential of asset and capital light businesses of airport adjacencies or airport ancillary service operations. We started as an airport operator and have over the years not only increased our airport portfolio, but have also built expertise in the airport ancillary business operations by entering into joint ventures and partnerships in the businesses of duty-free, car park, food and beverage, advertising, promotions, cargo, etc. The partnerships have helped us to develop capabilities and understanding of the airport ancillary businesses, as well as understanding of the non-aero commercial businesses at the airport. It has now enabled GMR Airports to leverage its expertise and experience to independently operate ancillary airport businesses. We will strengthen the GMR Airport platform as we build and scale ancillary business platforms. We will scale the platform presence across our own network of airports and also expand presence to external and open market opportunities. We have in fact operationalized the new opportunities. For example, GMR Airports has won a non-aero master concession and cargo business bids for the upcoming Goa airport. It is also the operating duty-free business at the Kannur International Airport. GMR Engineering and Management Services won an IT infrastructure bid for an airport in Kuwait. Secondly, GMR has signed shareholders agreement with Indonesia's Angkasa Pura II for the development and operation of Kuala Lumpur International Airport in Medan, Indonesia. The project scope includes operation, development and expansion of the airport over a period of 25 years. Kuala Lumpur International Airport is an operating airport with healthy cash flows. The project marks GMR's entry into the fast-growing Indonesian aviation sector, the largest in ASEAN and a high-potential market. Our commitment is to transform Medan Airport into a Western international hub of Indonesia. We are seeing visible signs of fast traffic recovery. Third COVID wave hit India from the latter part of December 21 and had an impact on the domestic traffic. However, the impact was significantly lower than the first few waves. International traffic, on the other hand, has not got impacted as much compared to the previous waves. Recent traffic data suggests that the third wave impact on traffic is waning. For instance, the daily average pax at Delhi Airport and Hyderabad Airport have turned around and has reached 58 and 56% of the pre-COVID level during the week ended February 6, 2022, respectively, as compared to 43% and 49% respectively during the week ended January 23, 2022. International daily average pax at Delhi Airport and Hyderabad Airport reached 47% each during the week ended February 6th, respectively, as compared to 42 and 45% respectively during the week ended January 23rd, 2022. The data indicates that the traffic seems to have bottomed out and is recovering rapidly. Cargo traffic remains resilient and is unfazed by multiple COVID waves. Precedent data indicates that the traffic is expected to bounce back quickly as COVID third wave is unlikely to be economically disruptive. We have seen similar traction in the previous two waves, even amidst restrictions in the airline capacity by the government. We anticipate domestic traffic to reach pre-COVID levels in fiscal year 23 and international in fiscal year 24 in our Indian airports, mainly driven by decline in COVID cases, rise in vaccination. As you are aware, cumulative COVID-19 vaccination doses have crossed 1.7 billion doses in India. Over 75% of the adult population in India has already been administered second dose, and over 52% children of 15 to 18 age group have been jabbed so far. Globally too, significant parts of the population of various countries have been inoculated with at least one dose. For example, US has reached a level of 75%, UK 78%, Canada 86%, Germany is at 76%, France 80%. Overall, 63% of the global population has received at least one dose. Various countries have also started administering booster doses to make the protection from COVID even stronger. This will aid passenger confidence to travel. Easing COVID-related restrictions. Scheduled international operations are still restricted by Indian government till February 22, and the entire international airline operations from India is functioning through the air bubble arrangement. Currently, air bubble arrangements are with 35 countries. However, various countries have started to ease and remove COVID-related restrictions, with UK in particular removing all COVID-related restrictions, and similar steps are also being taken by other countries in Europe, such as Norway, Netherlands, Ireland, etc. The Asia-Pacific region has also started to open up for travel for vaccinated passengers, and traffic has begun with key markets including Singapore, Australia, and Hong Kong. Government of India continues to track these developments and is expected that they may consider allowing scheduled international operations in the near future. Further, even on the domestic front, statewide restrictions on air travel have eased substantially with indications of further easing. In addition to this, fleet additions by major well-capitalized Indian airlines, especially the takeover of Air India by the Tatas, and entry of new airlines including that of Akasa and Jet Airways will further improve the traffic scenario. Lastly, we have made significant progress in our CAPEX programs. Delhi, Hyderabad and Goa airports have achieved 53%, 69% and 54% completion as of December 31st, 22. In Goa, as of January 31st, 22, we have achieved 60% of the CAPEX programs, and the airport is expected to be inaugurated during August 22 in a phased manner. I would also like to briefly touch upon the best practices and recognitions received on the ESG front. Delhi International Airport has been re-accredited by the Airports Council International (ACI) Airport Health Accreditation Program. AHA validates airports' health measures, implement practices that align with ACI Aviation Business Restart and Recovery Guidelines, and provide reassurance to passengers whilst demonstrating the airport's commitment to public health and safety, and grants industry recognition for excelling in safe hygiene practices. It was a proud moment for GMR that Mr. Vidya Kumar Jaipuriar, CEO of Delhi Airport, has been declared as the International Airport Review Person of the Year. The competition was stiff, with over 70 global nominations for the award, which finally got shortlisted to 10 odd people. Hyderabad Airport was awarded the Certificate of Merit at the National Energy Conservation Awards 2021. It was also awarded with the prestigious Excellency Gold Award in the Telangana State Energy Conservation Awards of 2021. ACI result for Hyderabad Airport stands at 5.0 for Q3 fiscal year 22. The presentation with all financial numbers are already available with you. If not, it can be downloaded from the Investor Relations section on our website. We are available to respond to your questions on this call and offline post the call. Now, I would like to open the forum where my colleagues from the airport sector and specific airport assets and airport corporate can answer your queries. Thank you so much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Mohit Kumar from DAM Capital. Please go ahead.
Good evening, sir. Congratulations on the demerger. So my first question is, what is the status of arbitration with Airport Authority of India? Can we expect the normal service to resume from FY23 onwards for revenue sharing? That's the first question, sir.
GRK Garu, you would like to take this question, please?
Yes. As far as arbitration is concerned, it is going on. And now the dates have been finalized for the month of May for the purpose of cross-examination as well as the final hearing. We can expect the final outcome from this tribunal maybe in the third quarter of this calendar year. As far as the revenue share payment to the Airport Authority of India going forward, we will look at it that if we reach the pre-COVID level operations by March, we may consider, but as of today, no decision has been taken.
Understood, sir. Secondly, sir, can you please explain the new arrangement with Bharti Realty and how does it affect our accounting for the this quarter?
No, there is no impact in this quarter. Whatever impact has already been given in the last quarter. The Bharti transaction is 4.98 million. Out of that, 2.78 million has been now, they have taken over and they have paid the entire money. I think we have explained in the last call. So almost about 1,100 crore rupees money has been received, including the annual license fee. For 2.78 million, the annual license fee is about 204 crore rupees has been fully received for 1 year on I think end of September. So that has already been accounted for. So this quarter we have accounted proportionately for 3.
Understood. Lastly, on this FCCB, in the presentation it mentioned that the FCCB amount is 1.4 billion. Is the amount correct, right? And what is the conversion price of the FCCB? Is it similar to are the arrangements similar like earlier, or is there some change?
Ashok, you want to take this on the FCCB? I think Ashok is not there. So quickly, I think the 300 million, the FCCB amount was 300 million, which in the demerger has been allocated 25 million to the airport sector and 275 million to the non-airport sector. As you are aware, prior to the demerger, the division was at 18 rupees per share. So it is substantially in the money. And the conversion has to be simultaneous. That is, that the FCCB holder has to convert both sides at the same period of time. At this stage, GPUIL, or the demerged entity of the non-airport assets, is yet to be listed, which would happen by end of February. So it will become very clear as to what are the pricing of both sides on the demerge, and the holder can convert it at that particular point of time. Last but not the least, because it is deep into money, the issuer also has the right to force the conversion of the FCCB if required. Having said that, we are always in touch with our key stakeholders. The holder, which is Kuwait Investment Authority, has been one of the most supportive investors, and we will do whatever is in the best interest of company and of the investor.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you. The next question is from the line of Atul Tiwari from Citigroup. Please go ahead.
Yes, sir. Thanks a lot. So post this demerger from GMR Infrastructure, how much of the demerged entities' debt and any other liability has been guaranteed in terms of the contingent liability?
So these are historical agreements that were in place. The broad contours would be that the continuing contingent liability would be about 3,500 odd crores going forward, which where the loans have moved to the new entity, which is GPUIL, whereas there is continuing guarantee from GIL. Having said that, if you look at some specific cases, for example, one of the continuing guarantees towards the acquisition finance taken many years back to acquire 30% stake in a coal mine in Indonesia. That was an acquisition finance done for about 500 million. Today, the exposure, the bank exposure over there is only 160 million. and the coal mine is doing extremely well. The current coal prices are quite buoyant. Every year, we are getting about 100 to 120 million US dollars as dividend flows on our 30% from that mine. Over a period of time, this exposure is going to reduce down to almost zero in next 12 to 18 months. Having said that, we are in the process of refinancing this particular facility, and in a short period of time, the guarantee given by GIL in the refinancing process will also get removed. There are few such instances which are there, which, honestly speaking, do not have any cause of any credit concern on GIL 1, but because these are historical in nature, over the next 6 to 12 months will get removed either through divestment processes or refinancings that happen on some of those financings.
Okay. So just to understand clearly, so the total, contingent liability / guarantee from GIL is 3,500, and most of it appears to be on account of this one item, $500 million acquisition debt taken at one point of time to finance the Indonesian asset, and anyway that debt is running down. So once that debt gets paid fully, there will be no contingent liability. I mean, nothing substantial, right? I mean, is that understanding right? Because 500 million is itself almost 3,500 rupees.
No, I think you misunderstood. I had given the example of 500 million, which was a debt taken almost 10 years back to acquire that mine, 7 years back. Currently, that 500 million is down to 160 million, which I told you. So the contingent liability only remains 160 million. Similarly, there are one or two other financings. In total, as I said, would be around 3 to 3,500 crores, which are there. These are assets which are well into money or have cash flows supporting those exposures, and hence, in the refinancings, will get removed over the next 6 to 12 months. That's what my indication to you.
Okay, sir. Okay. And sir, final question, will it be possible to share the breakup of consolidated between Delhi Airport, Hyderabad Airport, Goa Airport, which is under construction, and other assets, and the corporate debt?
Atul, this is quite possible. You can always contact us, but broadly, if you look at the total debt today as of December in GMR Infrastructure is 20,000 crores. 18,000 is put together in airport, and the remaining is corporate. So this is the broad breakup. The nitty-gritty details, you can always contact the team, and information can be provided.
Okay, sir. We'll call you.
That is net debt, basically.
Okay, sir. Thank you.
Thank you. The next question is from the line of Apurva Bahadur from Investec. Please go ahead.
Hey, hi, sir. Thank you for the opportunity and congratulations on completing the demerger. Sir, you...
Mr. Bahadur. Saurabh, sir, there is an echo coming from your line. Please check.
I am hearing it quite okay. Hello? Is this better? Is this better?
No, sir. There is an echo coming from your line.
You'll have to then dial me in again, or dial me into my mobile.
Okay, sir.
I have nothing open right now over here.
Okay.
Okay now.
Okay, let's go ahead.
Mr.
Sure.
Bahadur, please go ahead.
Yes, sir. So at the beginning of your comments, you highlighted that we are now looking to go big in the airport ancillary service business. So if I recollect correctly, in our previous calls, we never really touched upon this. So just wanted to know what has changed or why this change in tactic, and what sort of an opportunity size do you see over here?
Saurabh, sir, are you there?
Shall I take it also? Saurabh will...
Yeah, please take it.
Yeah. The adjacencies business concentration has been there for a quite long time. But we have not been able to, we were not fully doing it. Now, the concentration of GMR Airports Limited is to develop the adjacencies in airport sector, especially our area of concentration. Four: one is the duty free, other one is cargo, third one is a car park, fourth one is the master concession. There are the four areas identified by the business and where we wanted to do concentration. And for example, in case of duty free, we are already started operating Kannur duty free outside GMR Group. And as far as the master concession cargo, recently Goa has gone for a bidding, and where GMR Infrastructure has bidded and won the master concession of the non-aeronautical revenue as well as the cargo. So our endeavor is to develop all these businesses as SBUs within the GMR Airports Limited and to develop these one as separate line of businesses apart from the airport operation.
Okay, fair enough. And you see what would you like to put a number to this opportunity size over here?
The number of the opportunities, the numbers are not very big as of today. For example, maybe the Goa non-aeronautical revenue, the master concession and the cargo may grow in the full year of operation maybe about 100 crore rupees. And going forward, and for example, in case of the duty free of the Kannur is doing about 30 crore rupees. But as and when the opportunities are coming up, including the Dial and High International, we wanted to build these businesses as separate SBUs, as separate line of expertise by the GM.
Okay, just to comment over here, so far these adjacencies are run below the concession entities, right? So Delhi will have its own, Hyderabad will have its own. What we have decided that we should do these businesses at the holding company level, which is GMR Airports Limited. That allows us much greater flexibility in our businesses, and as these businesses get scaled up, it also allows us to go to and offer and bid for third party businesses. Previously, because these were housed within the concessions, that flexibility was not available. Now this is available. The market opportunity is huge. And all that we are demonstrating right now to you is that the confidence level is high. We have learned the ropes of this business, and hence we would like to make these businesses also on a global scale. That's the guidance.
Okay, so these will be at GIL level and not GAL level, correct?
No, it will be at GAL level, not at Hyderabad level or Delhi level or a Goa level. It will be at the GAL level.
Okay, very helpful. Sir, in your comments, I think in response to a question, corporate guarantee contingent liabilities, you said that a large chunk will follow up over the next 6 to 12 months as the sector refinance or spun off. My understanding is that 2,000 crore of this relates to Rajamundry guarantee. So is there any possibility or any progress on monetization or possibly sort of exiting that asset?
Yeah, so the guarantee is about 1,000 odd crores for Rajamundry. Having said that, there is a lot of traction as we speak with some of the divestment initiatives that we have taken. A combination of sale of equipment and land is also another possibility. So work is moving ahead quite well. We are of course also awaiting some of the new guidances from the Government of India with respect to combined tariff for gas-based businesses and renewables like solar. That will add further potential to such divestments going forward. So things are moving ahead, and as I said, you should see substantial visibility of many of these transactions between next 3 to 9 odd months. Earlier my indication was between 6 to 12 months, but some of these will happen even faster.
Okay. Sir, also, now that the airport business is separate and probably 2 to 3 years down the line, it will be quite free cash flow accretive. Would you want to come out with a dividend policy? So that, I mean, there's a clarity for the minority investors as well, how GMR Infra will go about distributing profits.
You're absolutely right. As we look forward over the next 2 to 3 years in some of the airports, there is going to be significant of cash accretion and significant amount of free cash for equity. We will be coming out with a dividend policy. Having said that, as you're aware, there is one more strategic action to be taken, which is with respect to the reverse merger of GMR Airports with GIL. There is still one layer in between, which we would like to remove, which in our agreements with Group ADP will be undertaken in fiscal year 25 after the testing of ratchets. So by end of fiscal year 25, GMR Airports would have reverse merged into GIL, and hence that layer would also get removed. And by that time, Hyderabad and some other assets should start throwing good amount of free cash, and hence that would be the opportune time for us to announce a dividend policy for the shareholders of GIL.
Okay, it's great to hear that. So just one last question, bookkeeping one. There are quite a few one-offs in the non-airport business, the discontinued ops part, right, in energy and other businesses. So can you please highlight what do they pertain to?
Can we keep that conversation for a later date when we talk about non-airport business? It's going to be listed soon, so we will talk all about what those one-offs have been. Let this conversation be on the airport side. Now that it's a pure airport entity, let's talk about airport.
Fair enough. Thank you so much. I'll get back in. All the best.
Thank you. The next question is from the line of Shreyans Daga from Barclays. Please go ahead.
Hi, management team. Congrats on a good set of numbers. My question is a follow-up on Bharti Realty that was asked earlier. So, if I recall correctly, you mentioned that the contract with Bharti Realty has not been adjusted. But in your presentation, it says there has been some adjustment. So, if you could show some light on that. And secondly, based on the figures, I think you mentioned there is no drawdown left from the transaction. So I guess if you could answer it, how much is currently outstanding from Bharti Realty? Thanks.
Yarki Garu.
Hello. Hello.
Yeah. Hello.
Yes, Mr. Babu, please.
Yes.
Okay. That is pertaining to the amount which we have reversed. Bharti is pertaining to the 1920 amount which we have recognized as income in the financials. And because of the delay and the contract, the payment has been received only in September. The amount of revenue recognized in 1920 has been reversed. That is the only one of the items which is the show as reversed. As far as the Bharti transaction is concerned, the 4.98 million square foot first transaction is divided into two parts, 2.78 and 2.17. 2.78 entire full payment has been received by 30th September 2021 and accounted for in the books. That means almost the RSD, ADC and 1 year of the lease rentals. Annual license fee has been fully received and accounted. So there are no dues from Bharti as of today. Entire amount has been received as per whatever the amount that has been agreed upon, entered into agreement and handed over. The second phase of 4.98, that is 2.16 million, that will be effective, that will be taken over by the Bharti between April 2023 to September 2023. They are bound to take it over. During that period, we will get the balance payment pertaining to that land parcel. Is it clear?
Yeah, sure. And how much approximate amount would that be?
If you consider in 2023 April, the balance 2.16 million square foot, both the ALD, the RSD plus ADC plus full license fee, three put together will be around 1,000 crore. 1,000 crore rupees will be there.
Okay, sure. Thanks, sir. My second question relates to average tariffs. So with regards to your CP with Airports Authority, could you give us some sense of how much is the year-on-year increase in average tariff for this year compared to the last year?
The tariffs are already implemented as far as the Delhi is concerned, which are under base airport charges. There is no increase as far as base airport charges are concerned. They are the same number till 2024 March, because this is the third control period tariffs. But when it comes to the Hyderabad airport, which has been now implemented, from 1st April 2022 onwards, the tariffs will jump. That will be currently 209 rupees per yield per passenger will go up to 430 rupees per passenger. Thereafter, it will keep going up substantial amount. So that is clearly provided in the tariff. That is not a percentage amount. They have clearly defined how much is the UDF will go up year after year. So that has been provided very clearly. But currently, 22-23, it is going to be 430 rupees yield per passenger, as against 209 currently we are charging. It is more than 100% jump will come next year.
Okay, sure. Thanks, sir. And congrats on a good set of numbers. That's it for me.
Okay, thank you.
Thank you. The next question is from the line of Mohit Kumar from DAM Capital. Please go ahead.
Hello. So thanks for the opportunity once again. Sir, in the slide number 25, you're given the 9-month FY22 console EBITDA breakup, for the, is it, do you have the similar number for FY20 pre-COVID?
Mohit, for all these numbers, you can directly contact us.
Sure,
this will be very helpful.
Sure. What is the capital expenditure you expect over FY22 full year and FY23 and FY24? Is it possible to share the number?
So all these data points, specific data points, whatever you need, you can always contact us.
Sure. I will get it. So
yeah.
Those are my questions. Thank you. Best of luck. Thank you.
Thank you. The next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Hello everyone, and thanks for the opportunity. I had a few questions from my side. I'll go ahead. The first question which I had was on the contingent liability. Just wanted some clarity that post the rounds of refinancing that you are suggesting, let's say 12 months down the line, how much of the contingent liability will still be there?
Just to again clarify, I'm not suggesting that it will be done 12 months down the line. I'm saying it will be all completed within next 12 months. So number one. Number two, in next 12 months, we expect zero contingent liabilities going forward. That is what our expectation is.
Understood. That clarifies. The second question that I wanted to ask was to a response with Mr. Babu. Now, 430 rupees, which is the yield for Hyderabad for the first year, which is FY23, is it going to be static or is it going to be going up as he was suggesting over a 5-year period?
It will go up. It will go up 22-23, 23-24, 24-25, and 25-26, March 2026. Only the last quarter of March 2026 it will be reduced. Otherwise, every year it goes up.
Understood. The next question that I had was more at an overall level in terms of pledging. Now that quantum was declining as the price point was moving up, and that quantum has started to increase again and is now close to about 40% of your overall shareholding. I wanted to get a sense of what is driving this quantum of share pledges up, and what is the thought process. From an investment perspective, it does become an issue that needs to be discussed at some level by the company, and that's I'm kind of seeking your opinion on this.
So honestly speaking, I mean, I'm responsible for the listed balance sheet, and really cannot comment on the nature of pledging. But I can give you this comfort that it is not too. It could be some blip in the interim refinancings. The trend line will only reduce over the short and the medium term. That much of assurance I can give you. The promoters are committed in reducing the pledges and bringing them to a much more reasonable number over the next few months. So I really don't know a specific reason why this blip has happened, but that much I can assure you that it is not for leveraging the equity and investing in some other businesses. It would be only limited to some of the refinancings that they may have in place.
Understood. That's comforting. And the other question that I had was that prior to the demerger, the kind of dilution that was supposed to happen on the conversion of SEC was quite meaningful at about 20%. Should we kind of see through that kind of meaningful dilution again as a scenario if in case for GMR Infra in its current form, FCCBs were to be converted?
Well, the equation remains the same. There's no change in the equation. If the conversion does take place, as you know that in the pre-demerger case, it was at 18 rupees, right? That was the contracted value. So they're deeply into money. If they were to convert, they will have to convert on both the sides of GMR Infra and GPUIL. And effectively, they get about a 10%, it will be a 10% dilution of the promoters in the entity.
Understood. So there will be a 10% dilution in GIL as it stands today, if in case that this event were to happen, right?
Correct.
Got that. Those were my questions. I'll get back in the queue for more. Thank you.
Thank you. The next question is from the line of Anshuman Ashit from ICICI Securities. Please go ahead.
Thank you for the opportunity, sir, and congratulations on completing the demerger process. So the first question is, can you please give us the gross debt figure as at the 9-month FY22 end?
This is gross debt of the airport sector?
Yes, of the demerged GIL.
If you look, let me come in here. The gross debt for the airport, the net debt, which I have already given the figure, was close to 18,000 crores. The gross debt is close to about 24,700 crores for all the airport debt put together, for all the assets.
Okay.
Which means that today we have close to 6,300 crores of cash in all the assets put together. That's why the net debt is 18,000 crores.
Okay, and at the corporate level?
If you look at the corporate is about, if you look at the total net debt and the gross debt, there's so much difference. So it is about 1,900 crores, because gross and net is same, hardly small, about 100, less than 100 crores that is there. Less than about 10 crores that is cash is there. So net debt and gross debt at the corporate level is same.
Okay. Okay. So second question is a clarification. We currently have discontinued the revenue sharing with AAI, and we intend to start from FY23 onwards. So will we have to pay in any retrospective basis also the revenue which we haven't shared for FY21 and 22?
No, it will not be. What we explained is that if we reach pre-COVID level of operation, the management may take a call about making the payment from next financial year. The decision has not been taken. However, as far as the 2021-22 current year, whatever the amount which we have not paid, that will be decided by the tribunal basing on the final order only. The amount, whether we are going to get or definitely we are going to get, is known. We are not expecting that we will get. We will be required to make any payment to the air.
Okay. Okay. So the next question is on the Goa airport. So we understand that the intention is to operationalize the airport by August. So is it on track? And secondly, when can we expect the tariff order to be issued related to the Goa airport?
Goa airport is going to start the operations by August. As Mr. Saurabh has explained, that we will certainly have a domestic operation from September onwards full-fledged. As far as the tariffs are concerned, we have already filed our application with the regulator, and we have discussed with them, because normally a regulator takes more than a year for a new greenfield airport to determine the tariff. He has assured that by the time we start the operations in August, they will give an ad hoc tariff required to meet our operational and other expenses. And after commissioning of the airport, within 6 months, a final tariff order will be expected. So we will have some tariffs on the starting of the airport. That will be that we should take care of all our operating and other requirements.
Okay, sir. And so finally, on the Kuala Lumpur airport, which you recently won, so could you give us some details about the revenue sharing and the potential revenues which we can earn from, some details, some color on the airport, some numbers which you could share?
It is an airport which was in operation. 2018, they have achieved about 10 billion. The revenue, this airport will be housed in a separate JV co, and in that GMR will hold 49%, and AP2 is the government entity which will hold 51%. That is the structure. And the revenue share payable by this JV co to AP2, I think we have already given the press statement, is about 18% revenue share payable.
Okay, sir. And so currently the airport is operational. So can you give us the passenger figure for FY21 if possible?
21, I think it has been operating around 3 million because of the COVID level. FY20, calendar, they follow the calendar year. Currently, it is doing better. We understand it's about 5.5 million they're operating.
Okay. And the max that the airport can handle is around 10 million currently without the expansion.
They have handled 10 million.
Okay.
The capacity that has been built is 12 million. So we will be, soon after we take over the airport, we will start a refurbishment of the airport. We will take the capacity to about 15 to 16 million within next 2 years.
Okay. Is there any related capex also which we are required to invest in the airport when the airport is handed over to us?
As of today, no, because once the JV company is floated, where we take 49% stake and 51% taken by the AP2, the initial equity investment from our side will be around $13 million. After that, we don't have any financial commitment as of today.
Okay. Okay. Thank you so much, sir.
Thank you. The next question is from the line of Kelvin Heng from PineBridge. Please go ahead.
Hi. Thanks a lot for the presentation and for the call. I just wanted to check, if you could maybe share some color on, what is the funding plan for the remainder of this year for Delhi and Hyderabad Airport, just in light of what is remaining from the existing capex plan. So, is there a need to return to the US dollar bond market later this year at either the Delhi or Hyderabad airport level to fund, the remaining outlays?
Okay. As far as the Delhi is concerned, we have already spent about 6,500 crore rupees. And this 2 months, so we may spend about maximum about 2 billion INR. We are still having sufficient cash, more than 20 billion INR Delhi is holding. Tapping the bond market, we'll look at it depending upon the market conditions. If there is any requirement, we'll certainly come to the market maybe after April. As far as the Delhi is concerned. And Hyderabad is concerned, they have already completed, payments have been completed more than 45 billion. And this 2 months, they may spend about 1.5 billion. And this airport, Hyderabad, is going to complete the entire construction by December 22. So balance amount will be spent in the next financial year will be around 20 billion. Hyderabad Airport, as of today, doesn't require any financing because we have completely tied up the entire financing of the Hyderabad Airport. However, for any subsidiaries adjacencies requirement, if there is any cash requirement, we will tap the market maybe in the month of April onwards.
Okay, understood. Thanks a lot. That's very helpful. And can you just remind me when is the expected completion date for the expansion at Delhi?
That is September 2023. And you might have heard already in the newspapers, we have partially opened the new arrival terminal for the Terminal 1. So we'll keep on opening up part by part. September 23 will be the full opening of the entire airport.
Okay, got it. That's perfectly helpful. Thank you.
Thank you. The next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Hey, thanks for the opportunity again. I had a few questions, so I'll go ahead. A couple of them relates to the Indonesian asset. Now, the government representatives from Indonesia, the minister over there, actually have talked about fairly large numbers of investment that GMR Airport will be doing in this project over time. It will be useful if you could quantify that amount to us, for us to get a better sense of how much will be the outflow over a period of time into this project.
I'm sorry, I could not understand. You are referring to Medan project?
Absolutely. In Medan project, let's say over a certain period of time, how much would be the investment? I understand at the start of it won't be there, but over a period of time, how much would be the investment going into that project?
The entire lifespan is about 25 years. The total estimated capex over 25 years will be in the range of 3.2 to 3.5 billion dollars.
So this is equity plus that 3.2, 3.3 billion dollars.
Total capex. So we, as far as we are concerned, as per our estimates, except for the initial equity we are putting it, and there will requirement much from the promoters. It will have a sufficient cash inflow to take care of its own expansion, like Hyderabad did.
Sure. Just to clarify on this one, when you say 3.2, 3.3, will this be from an equity perspective, whatever that amount is, will this be shared between the two entities, which are 49% shareholders?
No, it is a JV company will incur. There is no shareholders involved. It is a JV company will incur.
The related question on Indonesia, should we be assuming that it will be throwing up cash in the initial few years when you are not doing any capex and the volume levels are normal?
Just to clarify over here, I think misunderstanding. What GRK Garu is saying is the total development cost of capex over a 25-year period. I think your question is how much of equity investment will go into it. Correct me if I'm wrong.
It would be a good number to be having as to how much would GMR from an equity perspective be investing, let's say over the 25-year period in this asset.
Well, 25 is a little longer period for me to give you guidance on, but over the next 5 odd years, where bulk of the development will happen, our investment will not be more than 120 million US. Obviously, the JV partner will also contribute in that, and the balance will be leverage that will be taken. And this is notwithstanding the internal accrual, because this is an operating airport, right? So the internal accruals will further supplement any requirement on the development side.
Sure.
So it's a pretty limited equity investment in that airport.
Sure. And the last question that I was asking was, should we be assuming that there would be internal accruals in this project at, let's say, once it comes back to pre-COVID levels, even after the revenue share that you have promised?
Yes, it has sufficient, because the revenue share payable is only 18%, and it has got good revenues, and we are going to expect our expertise is going to be used for development of a lot of non-airport revenue. The project itself will throw a good amount of cash that should be plowed back for an expansion, as Saurabh has said, instead of resorting to the shareholder funding.
Sure. A subjective question from my side. It seems that Goa and Indonesia both appear to be good investment prospects for you. Would I be wrong in saying that Indonesia can be even better than Goa from the perspective of the value generation that happens over time, given the terms? Because obviously Goa is a higher revenue share also.
That is an obvious answer.
Potentially, I would say yes, potentially. And I will attribute it to certain geographical attributes that Medan brings to the table. So if you look at the location of Medan, it is actually in direct competition with Changi and Kuala Lumpur. And if you look at the traffic flow from Europe into that part of the world, this can be an alternate hub to these two destinations, and hence can be a very meaningful play going forward. But that's the thought process in which we also identified this as a destination, and that's how we had invested there. Now that is as far as geographic locations and traffic, but you should also look at Goa from the real estate side of it. So I mean, as you're aware that airport is not merely earning tariff regulated earnings, but also the non-tariff related, which could be the non-aero and also the real estate side of it. Goa offers a very compelling real estate side of it. It is a fully environmentally approved land parcel around that for hospitality development, which, as you may be aware, Goa struggles to find hospitality rooms given the nature of environmentalists in that part of the world. So you don't have hotel rooms coming up, but you have villas coming up, and those villas are extremely expensive. So you have to view it more holistically. But yes, Medan, of course, offers a very compelling proposition to airlines as an alternate destination into the gateway of Southeast Asia.
Understood. Now, the other question that I had was, I would assume, from what I know, that there will be more prospects beyond Medan for you and other operators to be bidding for in Asia, given the drive towards privatization that is happening over there also, and the business model is uncertain, completely agree, but there'll also be opportunities. Now, from a funding perspective, I also see that from a GMR Airports perspective, there is still a standalone debt that is there. And I'm trying to kind of grapple as to whether there is enough support that you would be having, given the opportunities that may be coming up in India and Asia. So if you could give us some sense of how you are thinking through from an opportunities perspective and from the perspective of you actually bidding for them.
Well, that's a very fair question to ask, and the response is multifold. Number one, I think we had alluded to earlier in the presentation that many of the adjacent businesses are now being brought out of the concession entities into the main entity, which is GMR Airports, right? So that entity will no longer be just a merely holding company. It will be an operating company with many SPUs, and these are very fast-growing businesses which will be there. So it will throw up cash. It will also have financing capacities available at GMR Airports going forward. That's number one. Number two is, let's look at various opportunities that are coming in India and in Southeast Asia. Most of them are brownfield airports, do not require too much of equity outlay, requires a lot of efficiency, and has the ability to use without recourse debt for the development of those concessions. We intend to play that strategy out going forward. Third is, as you are aware, there are many assets in our book now which are not maturing. So we have the option, and I don't want to be pinned down on that, but we have the option to monetize some part of equity of a mature asset and take that money and put into a development asset. So, from an arbitrage perspective, earn much higher returns on the same capital as I look at opportunities coming both in India and abroad. Last but not the least is you have to look at also that GMR Airports is a joint venture, so it is GIL which will contribute some equity and EDP will contribute some equity. But in our scheme of things, like we did in the case of Delhi and Hyderabad in early days, there is a lot of tailwind by many of the sovereign and pension funds who want to actually participate on the equity side of it at the asset level itself. So, a combination of many of these things will play out, which ensures that the current perceived lack of capacity of GMR Airports because of the debt of 3,000 crores on the GMR assets book does not become constrained, and we do not lose out on the growth opportunity going forward. So it will be a combination of these things that will be playing out. I cannot give you a very specific answer because that will be a little market sensitive from my perspective.
And lastly, on that corporate debt that is sitting at this point of time, obviously there is no way of servicing it given the state of affairs at the airports front from a capex perspective. Is there an end game over there that you would want to kind of elaborate on to take that kind of stress out?
So we will be refinancing that debt. That is a process which is already underway. That will be refinanced. Like I told you earlier, the stress comes because if it is not an operating entity, in 3 years' time, GAL will be a very vibrant operating entity which has significant businesses in duty-free, in F&B, in cargo across India and across Asia. So we need to keep that into mind. It will be very easily available to manage that debt. You also must take into cognizance that GAL also gets certain operating fee and management fee from the assets that it manages. Going forward, that will continue to play out. So there will be a significant amount of predictable, assured management fees coming from the airport assets to GAL for it to manage its own balance sheet. So again, multiple streams of income, cash income, and also a recycle of capital and partnership will play out as GAL looks for further growth opportunities in India and Southeast Asia.
Crystal clear, and all the very best for 3 years from now. I hope that once things become a lot better and the reverse merger happens, it will be a fantastic entity to see in terms of cash flows. Thank you.
Absolutely, and that is the journey, Apurva, that we are looking at. Is just a bridge to substantial value creation in fiscal year 24-25 when all contracts get settled.
Mr. Motion?
Yes. Thank you. My questions are done. Thank you.
The next question is from the line of Apurva Bahadur from Investec. Please go ahead.
Yep. Thanks again, sir, for the opportunity. So quickly, I think you highlighted that the conversion ratio for FCCB will be around 10%. I mean, that the dilution at GMR Infra level. Can you explain the maths over here? How does it change from 20 to 10?
Can you just have this question taken offline, and I would rather discuss it. It's just a maths. Maybe Amit can send you the maths on this.
Sure. Thank you.
So there are different price points for the airport and different price points for GPUI. So he will send you the math as to why the promoter dilution is around 10%.
Okay. Thank you.
All right. Thanks.
Thank you. As there are no further questions from the participants, I would now like to hand the conference over to Mr. Saurabh Chawla for closing comments.
Yeah, thank you. Thank you, everybody, for participating in our Q3 call. Really appreciate your time. The IR team is available offline to answer your specific questions, especially those which we said that we will give you the further details. So please reach out to both Amit and Vishnu, and they will answer all questions. And look forward to your inputs going forward. We are sensitive to the inputs by the capital market players, and I can assure you that our strategy will get tweaked because we believe in value creation. And as on date, any value created, 63% do go to the promoters. So we are working towards that. We are working towards asset-light, capital-light business model. The big capexes are getting over. New opportunities will come, but those will be mostly in partnership, so they should start yielding good equity value for the shareholders. Last but not the least, the cherry on the pudding is the adjacent businesses that I've talked about. Look at it seriously. Look at what the duty-free throws at Delhi Airport and Hyderabad Airport, and when you start to extrapolate that into an independent business unit at GAL with the world as a platform, you will get a very different outlook. So look forward interacting with you offline, and take care and be safe. Thank you so much.
Thank you. Ladies and gentlemen, on behalf of GMR Infrastructure Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.